Let's dive into the first step of IFRS 15 in more detail. Step 1. Identify the contract with the customer. This step focuses on determining whether a contract exists between the entity, in our example, XYZ Electronics, and the customer. Identifying a contract is a fundamental starting point for applying the revenue recognition standard. Key elements in identifying a contract. 1. Agreement between parties. There must be an agreement, either written, oral, or implied, that creates enforceable rights and obligations between XYZ Electronics and the customer. This agreement can be in the form of a purchase order, a signed contract, or even an online order form. Example, a customer visits XYZ Electronics website and adds a smartphone to their cart. When they complete the checkout process, agreeing to the terms and conditions, an agreement is formed, constituting a contract. 2. Commercial substance. The contract should have commercial substance, meaning that the parties expect to receive something of value. Contracts for trivial or insignificant items might not qualify. Example, XYZ Electronics contract for smartphone sales has commercial substance since both parties expect to exchange a valuable smartphone for payment. 3. Approval and commitment. Both parties should have approved the contract and be committed to fulfilling their respective obligations. This implies that there's a mutual understanding and intent to perform. Example, the customer commits to paying for the smartphone, and XYZ Electronics commits to delivering the smartphone. Both parties have approved the terms and intend to fulfill their obligations. 4. Collectibility of consideration. It should be probable that XYZ Electronics will collect the consideration, payment, to which it is entitled under the contract. If collectibility is not probable, the entity may need to use a different accounting model. If XYZ Electronics has a history of customers defaulting on payments and the likelihood of collecting payment is low, it could impact the recognition of revenue. 5. Legal enforceability. The contract should be legally enforceable in most cases. However, enforceability may vary by jurisdiction and may not be necessary for some contracts. Example, XYZ Electronics online contract is legally enforceable, but for certain small value contracts, legal enforceability may not be a primary concern. 6. Identifiable rights. The contract should specify the rights and obligations of each party clearly. If XYZ Electronics cannot identify its rights regarding the promised goods or services, it might not meet this criterion. Example, the contract clearly outlines that the customer has the right to receive a smartphone, earphones, and a warranty in exchange for payment. Why is Step 1 important? Identifying a contract is critical because it determines whether the revenue recognition guidance in IFRS 15 applies. If there's no contract, there's no revenue to recognize. Properly identifying contracts helps entities avoid premature or inappropriate revenue recognition and ensures that revenue is recognized when the criteria for revenue recognition are met. In summary, Step 1 involves assessing the existence of a valid and enforceable contract, which is the foundation for applying the rest of the revenue recognition model in IFRS 15. This step helps companies like XYZ Electronics ensure that they are dealing with genuine customer agreements before proceeding to recognize revenue.